on volume profile as well, and the heat maps back in December 2010. So time does fly. Well, let's get started. Today I'm going to be talking a little bit about volume profiling techniques for both imbalanced as well as balanced markets. I'll do a quick intro to myself just in case some of you guys are not so familiar with L2ST and myself and my work. Well, firstly, I've been trading for over 11 years. I've been trading, firstly I started trading mostly through retail brokerages, and for the early part of my trading career, that's how I built a successful and profitable track record. Then in 2005, I was backed by a London-based prop firm, proprietary trading firm, and became a professional proprietary trader. And later, during my journey, I was backed by, I was provided a unique opportunity to clear and trade my own capital through a very large and very successful prop firm in 2008, and that's how I continue to trade right now, and continue to do so. So a little bit of an understanding of where I come from. I did start off, like many of you probably, as a retail trader, but once I started to get some consistent results, I was brought into the world of prop firm trading. And I have a unique setup right now where I do trade my own capital, which is quite different to the general prop firm setup where they do back you, and that's how I started in the business. But some of the prop traders are given that opportunity, and that's what I do right now. Right, so also I do own L2ST and L2ST Traders Coaching Services, where I focus on helping other traders like yourselves improve their trading performance and the results. Some of you may not be too familiar with my particular method. My method of trading is not a system. It's not it's not a buy setup, sell this setup, buy this setup kind of system. It's a discretionary approach, and you guys that are here that understand auction market theory principles will understand that is a discretionary approach. The core of my method, although however, has remained the same, and since I started to trade profitably, which is one of the realizations that I came to quite some time ago. And although I started trading in 2001, I didn't actually get consistently profitable results until around 2003, and that's really when it really kicked off for me. And one of the things that I realized quite a while ago was that you have to understand the context of the market. You have to understand what setups work at what times. And one of the realizations that I come to is that actually most traders trade the same setups, but the issue arises when you're taking the setups at the wrong times. And timing is the most important thing here. So one of the reasons why I have focused specifically on volume profiling techniques for balanced and both imbalanced markets is because the way you approach both phases is very different, although you may use the same technique. And that's really what I want to focus on today. You're not going to get everything today, but it's my job to empower people. And even if you could just take one or two good things away from today and make it practical and put it to use, that's I've done my job. So as long as you can pick up something today, that's great. My method, as I said, is discretionary. I focus on trading based upon the auction market theory principles. However, over the years, I have evolved and continued to learn, and the tools and the features, especially within the Market Builder software, has continued to evolve, and does make my job a hell of a lot easier as a trader. One of the first things that I learned as a prop trader in 2005 was I learned the purpose of volume profiling and market profiling, which was completely new to me at that point in time, but I very quickly realized that it was a method that really complemented the way that I was trading and my trading style firstly, which was being adaptive. And that was one of the key things that led to me becoming consistently profitable, was constantly adapting to the ever-changing market environment. And when I learned volume and market profile as a proprietary trader, I learned that it complemented my trading style really, really well. And since I've grown with it, and I continue to evolve and continue to grow. So what you have to remember, though, with auction market theory, it's not a system. It's a method of understanding the market and volume profile. Tools are to be used to read the information that we need. And there are many ways to use the information, and I will urge all of you to become creative with your understanding. And whatever you gain from today, just become creative with it. You know, there is not one way to use volume profile or market profile or any of anything that I've got to share today. Just there is a lot of different ways you can put it to use. So I do urge everyone to become creative and also make it their own. Right, so we'll start off. Just going through some of the key concepts of auction market theory that I feel must be understood before we start focusing on the practical application of these concepts with market data and its profiling capabilities.
Cam, Cam, to interrupt real quick, I'm not sure everyone can see your screen.
Right, okay, let me just start it again. Thank you very much, Trevor. Okay, there seems to be a problem sharing my screen here right now. I'm not sure if you guys can still hear me, but I'm just going to restart the program quickly. It looks like there's a problem sharing the screen, Trevor.
Okay, you go ahead and if you want to exit and then come back in.
You can just take over the
Sure.
controls, and then I'll log back in.
Sure.
1 minute, please.
Okay.
Thanks.
All right, everybody. I might as well take the time real quick while he's coming back. Here's our website. If you do want to take the trial after today, under products, charts, that's all you need to do. It gives a breakdown of the different editions of the software, as well as the free trial link. The version Cam's using is the professional edition. This is the one you would need in order to accomplish all the charts and things that he has and different settings. So just want to show you that while we're waiting. You can read more about this under Market Delta Professional. I'll maybe post this. Actually, let me just post the previous link. Here you go. And then we'll email a link to the recording tomorrow morning or midday. You should get a link to download the recording if you'd like. So keep that in mind. Look out for that email. And then we post everything back up to the video library under support. We'll try and link it up here under webinars, the webinars category. You can always come here and go through really any of the past special guest webinars. We try and put those up here. And then last but not least, webinars. This is a new page that we've put together where we try and keep about a month's worth of webinars front and center. So you can always visit here to see what's coming up, register for any or all of them. We're always going to be free, so you won't have to worry about that. So many of you probably already know about that page, but it is something that's fairly new, so we want to make sure about that. All right, so I'm just waiting here. I see he's logged out. He'll be coming back in just a second. Maybe while I'm waiting, is there any questions for me? I'll entertain a few questions just up until a point where he's coming back. Okay, the trial is 30 days. It's 30 days. It's of the topmost edition, so you have full functionality there, so you won't have to worry. You'll have all functionality with our full support. You do need a data feed for the trial, so here's a link to the data feeds. And it looks like Cam's back, so let me go ahead and turn it back over to him. Bear with me.
Right, guys, I apologize for the technical difficulty there. Just want to make sure you guys can see the screen. Can you guys see this?
I can see it now. It's coming
good.
through.
Thank you very much, Trevor. So you should be looking at a screen that says important questions.
Yep, it looks like that's the case. Everybody's confirming.
Good, good. Thank you very much, guys. Sorry about that technical difficulty. These things happen. Of course, you guys know. Right. Well, firstly, some of the important questions we've got to ask ourselves as traders. Like I said, I'm just going to go through some of the theory first, and then we'll go through the technical stuff, and then I'll go through the more of the how to apply this theory that you begin to understand. So some of the important questions we firstly have to ask ourselves as traders: is the market balanced or imbalanced, or at least attempting to become balanced or imbalanced? So I'll show you some of the ways to recognize that today. And then the other question we've got to also be aware of is, where is the price advertising? And where is it likely to trade towards? And this is quite often referred to as the destination. Where is the market likely to go from and to? I often talk in my trading room about where I'm anticipating the market going from and to. And I have multiple scenarios in my mind's eye before the market even opens. And one of the reasons I'm able to trade around those ideas is because I envision them firstly and visualize them firstly. And so when those scenarios start to present themselves in the moment, I can adapt to them and also take on board and understand where I expect that market may be potentially heading towards. The other question we've got to ask ourselves is, where are participants likely to accept and reject prices? And this is really what I'm going to focus on today. I'm going to focus on understanding where the participants are likely to accept and reject prices, understand where they may take the prices from and to, and understand also whether when the market is balanced as well as imbalanced. Right, moving on. There are three fundamental elements to the market's auction. Firstly, there is price, which is simply the auction's means of advertising opportunity. It's the most volatile variable, and it's the fastest moving market element. So price is normally what most traders will focus on, but what I want you guys to do today is recognize that the way you look at price, you need to look at it in a slightly different way. It's the most volatile variable, and it's usually the most misleading as well. It's very fast moving, And if you focus on price alone, it's very good for execution, but if you use it for context, it can be very misleading. And then, of course, there is time. Time is that which regulates each price opportunity. It is a constant around which all auction data is organized, and it is when the market trades over time, we can establish how interested, and this is the key thing, we can establish how interested market participants are at specific prices. Lastly, we have volume, which measures the success or failure of each auction, higher or lower. Volume is also a variable, but it changes much more gradually than price alone, and it represents the interaction of market participants. And for me personally, and much so for my followers and my students in the trading room, it's the truest reflection of the market participants' behavior and the level of interest over time. Now, if you begin to analyze a volume that's traded at prices, you'll be able to measure the success or failure of the price advertisement. So remember, if price is the advertising mechanism and volume measures the success or the failure of the price advertisement, it's a key thing to understand. Okay? Now, moving on. So there are 3 key observations that we must make. Firstly, you've got to understand context. Secondly, you have to understand acceptance. Thirdly, you have to understand rejection. Context is all about understanding which context the market is currently within. Acceptance is understanding which prices have the majority of market participants proven they are interested in accepting. And rejection, which prices have the majority of market participants proven that they are rejecting. Let's now look at context, acceptance, and rejection a little bit deeper before we move on to the more technical stuff. So context, what does it do? It provides us understanding, a story, a framework for working with, a vision, and an objective. So what does that mean? Well, firstly, you have to understand where the market is trading. You have to understand within which context you are trading as a trader. So the context firstly provides an enhanced understanding of the current market situation. It provides a story for you to work with in building your trading ideas. It also provides a framework for doing business. And of course, it also provides your context so that you can have the ability to form a vision for what the market may be attempting to do. This, therefore, allows you to have what I will call is an objective opinion rather than a subjective opinion. Now, somebody that's trading just a system will see a buy signal or a sell signal and take that trade just because it's a system signal, but they will not know why they should take it. Whereas discretionary trading is all about understanding. It's about applying how well you understand what you know about the market. So, it's really important that you guys understand this is not a system and this is an objective. It's about forming an objective opinion of what may happen next. So some of the things we might ask ourselves, forming a context and improving our understanding is firstly understanding market structure, what is evident. We may ask ourselves whether the market is balanced, trading sideways, or whether it's imbalanced or trending upwards or downwards. Then we may move down to the approach of using a top-down approach. And normally I would recommend you start with a bigger picture. So as day traders, I start every day with a daily chart, then a larger time frame such as a 30 to a 60-minute chart time frame. That gives me the main context for where I am trading and what I'm expecting from a longer time frame perspective, because that's what I am trading in line with. And I personally, for some of you guys that don't know, I personally trade 30 to 60 minute chart setups, but then confirm them with shorter time frame confluence and order flow execution setups from the market order footprints, as well as the time and sales, as well as price rejection and acceptance that I see from a shorter term perspective. Acceptance. Let's have a look at acceptance. Firstly, we are interested in knowing where the market participants have accepted prices in the past, as well as where they are accepting them now. Very frequently, we will find that market participants will accept and facilitate trade where the market has proven to have found efficiently facilitated trade in the past. And generally, this is shown by the high volume areas or high volume nodes. This leads to further volume at price building, and therefore, for the market spending further time in those areas as well. Generally, that leads to the market getting stuck in those areas. It spends a lot of time there. It normally does what we would, as traders, define as chop sideways. So for me, it's not the best place to do business, but we need to be aware of where the price may accept, more so for profit taken rather than actually getting into trades. And I know some of you guys may have gone into market profile looking at high volume areas as for doing business in terms of getting into trades, but I would strongly urge you to recognize that acceptance areas and high volume areas, the VPOC, the areas where we see a lot of volume trading or where the market spends a lot of time, those are better areas for targets rather than places for entries. Let's move over to rejection. Now rejection, it's areas where we found the market found unfair prices, or the market participants found unfair prices. However, advantageous and therefore providing the best deals. So the reason you have to understand why we have these rejection areas is because the market finds these areas advantageous. The reason the market spends less time there is because each time these areas are revisited, the opportunities are snapped up very quickly. So, you've got to think about it yourself. If you are looking for a good deal, you're going to snap it up quickly. So when a good deal is available, traders will take advantage of those price advertisements very quickly. And that's what I'm looking for personally as a trader. I'm looking for the market to move away from my areas for doing business really quickly and move away from those areas. So rejection is a key thing that you have to understand and understand where rejection may take place. Generally, this leads to the market moving away from those prices. It detracts trade. And this is what we need to look for as traders for key reversals and great trading opportunities. So as a general rule, the best place to look for entries is a low volume area or a rejection area, and a target is best looked at being at a high volume area or an area of acceptance for profit taking. One thing I would also mention is that we do have two types of rejection. There are rejection reverse scenarios where we test an area of rejection and we move away from that area of rejection. And then we also have pass-through rejection where we test an area of rejection, we pass straight through it. Now this is where the order flow concepts come very much useful, and this is why I will look at a low volume area and I will consider it as an area for doing business. But if I don't see the opportunity to get in as defined by the order flow, the price rejection that I see, as well as the footprints, what they are showing me, I don't get in. So do understand that any of these areas for doing business doesn't mean you just put an order in and get in. There is a way to do business at these areas, and you do have to learn how to execute at these areas, and you do have to learn how to manage the trades once you get in. Okay, I'm not covering that today, but it's something that you must take note of. So now I'm going to look at some basic simple rules for setups for applying this theory and understanding it within the context of both balanced and imbalanced market phases. Right. Firstly, let me just talk about some of the characteristics of balanced markets. Some of you guys are familiar with balanced markets or sideways markets, if that's what you want to call it. Balanced market is basically just a sideways market. It's a market that's generally we're tracing between 80 to 100%, sometimes extending from around 130% to 160% outside of the range that we're currently trading in. So technically, it might look like something like this, if I can just show a drawing. So you've got 80%, 100%, and then 130% to 160%. So that market is still balanced as far as we are concerned. Now, there are ways for me to show you this technically, and I will show you later on today. So you must be aware of the characteristics of balanced markets as well as imbalanced markets, because firstly, before you apply acceptance and rejection, you must understand the context. So that's why I covered context before, as well as acceptance and rejection. Before you apply the techniques of reading acceptance or rejection, you must firstly recognize whether the market is balanced or imbalanced. And you must also understand the context of the market, whether it's trying to move higher or whether it's trying to move lower. And I'll move to some examples of the E-mini S&P recently, actually, because it's been very evident that this market has been trying to move higher. And I want to show you guys how you could have picked out some of the best areas for doing business as it's been trying to trend higher. So, balanced markets, coming back to that. What we will normally find when we draw a profile over the range where the market is moving sideways, we'll find most of the volume is traded towards the middle. And we will usually find that the profile is fairly fat and also very symmetrical. Again, I'll show you some examples of this. This is just a theory. The market will also spend much of its time balanced and will spend much of its time being accepted in balanced areas before it decides to move away. And one of those reasons that I focus on trading balanced markets and fading the market so much is because I understand the markets do their job best, which is to facilitate trade when they are balanced. So when the markets are balanced and they are facilitating trade, I tend to look at fading the unfair highs and buying the unfair lows. And most of you guys that follow my work will know that's what I tend to do on most days. And there will be, of course, some days where the markets become imbalanced and the market starts to trend. But those days are very few. There's not many of them. And those days I sit aside and just let it go. There's been a few in January, and there's been a few cases in February. But I will sit aside in those situations and just let the market move away. Now, there are ways to get involved in those opportunities. I do cover them, but it does depend on your risk-reward, the risk-reward that you are looking for and your objectives in your business plan. So each and every single one of us will have different objectives. We will all be trading different amounts of capital. We will have different objectives, different targets. So if some of us are looking for, for example, 4 to 8 ticks on the S&P, it's very different to somebody that's looking for a 7-point move, which might be 35 to 40 ticks. So you have to understand that these concepts have to be put into the context not only of the market but also of yourself. What is the context of yourself? What is your business plan? What is your objectives? So please do take that on board as well. One thing I will note, though, I have talked about the key concepts and the characteristics of balanced and imbalanced markets in a blog post that I'll put on the website. I'll just quickly direct you towards that. Now, if you go to our website, you can check out the blog. Recent article about the best setups, settings, etc. And I'll talk about the characteristics of imbalanced trending markets as well as balanced and range-bound markets. Now, I've just covered them briefly, but please do check that out if you get a chance. Just go to l2st.co.uk blog. Right. Okay, so some of the ways we can identify opportunities in balanced markets is firstly identify prior areas of rejection. Prior areas of rejection meaning where low volume traded previously, not necessarily right now, but previously. So we will look at what is commonly known in the industry as LVNs or low volume areas. So LVNs or LVAs if you like. Above and below the area you believe the market to be finding value around, the market participants believing to be finding value around, and also trading sideways around and balancing. So if you find those areas of balance, those key areas of acceptance, the best thing to do is highlight where rejection is taking place or has taken place above value and also below value. Technically, the rules are to aim the short to short the LVNs above value for targets that are within value or below value, and then aim to buy the LVNs below value and target within value, which may be the highest volume area, and then also aim for the value at high. So that's typically how I approach my trading. So one of the things you can do to highlight these areas in balanced markets, if I just move to the charts here, firstly you want to start on the daily chart. Okay, just give me a minute here guys, I'm just going to quickly take a drink of water and I'll be back. Right, so let's have a look at the daily chart. That's probably the best place to start. One of the best things to do when you're looking for key support and resistance areas for a balanced market is to look at your daily chart. So use a what I would call a top-down approach. Key thing to do is start your next lower time frame from a key area. So in this situation, one of the things we'll use as an example is the last major low in the E-mini S&P. So we're looking at the E-mini S&P right now. The last major low on the E-mini S&P was around this 1195 area. But a key high has been put in this area. What I've done here, let me just draw this again. What you can see here is the market is uptrending. This is probably a little bit more specific to an imbalanced market. So if you understand that low volume areas are key areas of rejection, generally that will detract trade. If you think about it, when you are a trader, what are you looking for? You're looking for the market to move away, right? So it makes a hell of a lot of sense to look for opportunities for entry at low volume areas. Contrary to what some market profile theorists may think or believe, I have found personally, from my own experience, and I'm sure a lot of other professionals have also as well, found that low volume areas are the most important areas to watch for entries. So we all know on the E-mini S&P, we made a major low in December. just before Christmas, and we haven't really stopped that push higher. One of the things you'll recognize here, I just want you to recognize that if I take a composite profile, now there's a number of ways you can draw this. You can right click on the chart, and you can go to this option here, show toolbar, and you can draw a profile with this option here, and the profile drawing tool. Now if you draw that, you may have to change some of the settings. So I've already changed some of the settings, and I'll explain what they are. But let's just take this to the last high, from the last major low to the last high. What you'll recognize is this market is currently been testing a few key areas of low volume. The low volume areas are actually represented as red lines. Market Data actually has the ability to show you the low volume areas and the high volume areas automatically, and also you can now color code these. So I am not that interested in high volume areas. So the most recent version of Market Delta has the ability to change the colors for peak lines and valley lines, which basically means that you can change the color for high volume nodes and low volume nodes. I am more interested in low volume nodes. Now, one of the options is, of course, just turn this black and change the background, the background of your charts to black, and you will no longer see anything. Right, so let's get that back to the way it was. Right, so that's probably not a good idea, but something's not quite right there. But you can change the background color to match the high volume nodes so you cannot see them. That's the key point that I'm getting to. So let's just do that again. I just want you guys to notice here, since this last low, this one, or you can take this one, there is no right or wrong here. Let's just take this last major low right up to the high. And notice, where has the market found support? Remember that low volume areas are the red levels. Okay? Notice here, pull back, low volume node. 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 Pull back, doesn't quite get to the red level, but what is this? Low volume area, right? Continued higher. Right, so one of the first things you want to do on a daily chart, though, is start with a key high to low. Now, one of the things that I'm doing on the daily chart right now is focusing on the 2007 highs. So you can either take this high in July 2007, or you can take this high in October 2007. So that's a key high. So what I do is then draw that on my longer time frame chart. In this case, I've got a 15-minute chart, but that generally could be a 30-minute, 60-minute chart. That's a nice longer time frame. And what you want to do is change the start date of this profile. Change the start date of this profile. So October 2011, 2007 is the start date of the major high on the daily chart. So I want to know where this market is going to reference key acceptance and key acceptance and rejection areas on the way up, right? So it's important for us to know that. So one of the things we can do is draw a profile. If I just grab this button here, now you can just draw this with the profile drawing tool. Let me just take this low to high here, and then double click on the profile. And then the key thing to do here is just draw any profile. Now it's totally down to you if you want to tick this box, which will automatically identify the peaks or valleys. You don't have to do that. Okay. Now personally, I prefer to highlight the areas myself, but for the example of this presentation, I will leave that automated. And then the next option is to leave this set to all bars. So if I have set the beginning of this chart to start at the time of a major high on a daily chart, and this is a 30-minute chart, remember, it will take into consideration all of the key areas of acceptance and rejection since that major high was made in 2007. And that's what I want to look at, right? So what that will do is give you some key areas. And you can see how this market has been trading around these areas, even today. Look at it. Okay, what did we do over the last week? Okay, we tested what? Key low volume area, rejection area right up here. What did we test before we pushed higher? A key rejection area right here. Okay, what did we test today earlier on? And this is actually the area I was getting long at in our trading room today. Key low volume area here. And what was our target? Right up back towards the 72s. The 71s and 72s right up here. And what has the market done since it went into that low volume area? Now remember, these are low volume nodes, these levels, the red lines that you see on the chart. But I want you to look at these not as specific levels. Although a lot of the time they will hold very closely and very much to the tick, they don't always. And sometimes we will have to test above a key area, sometimes we will have to test below a key area and still hold. Now 64 was a key area for me in our pre-market analysis today, and so was 65, and so was 66. And I actually mentioned in our pre-market analysis today that 66 to 64 was an area that I was looking to buy. And it's an area that you want to look at, not specifically a key level. So although we do have levels, okay, I do want you guys to recognize that these levels will not hold to the tick, and sometimes we may have to test above and below these levels before we actually hold. So one of the things we can do, just have a look at what happened today. That's probably the best example for a balanced market, because we came into today bear with me. Okay, we came into today understanding that this market was balanced around and potentially accepting around yesterday afternoon's range. Okay, now that's part of the story. It's not the full story, it's part of the story. Okay, and one of the reasons I actually ended up buying today this morning in this area was because of what we saw as an acceptance range. What I talked about earlier, where market participants were proven to be accepting prices over the auctions range. And yesterday afternoon we accepted that range. We couldn't push lower. We held this 65, 66 area. So it's a key area, a low volume area, not only a low volume area, but a low volume area below a key area of acceptance. And then we pushed higher. And then what happened? We pushed higher towards a key low volume area above this area of acceptance and pushed back lower. And actually that was one of the expectancies of our trading room earlier today before we finished up. All right, so the key thing here is that, you know, it's not about being right or wrong. I a lot of the time may be wrong, okay, but a lot of the time I also will be right. And the key thing here is understanding what is most likely to happen before it happens. And the only way to understand that is if you understand the auction market theory principles, and then you start to apply these tools. So, you know, that's a good example of a balanced market. You know, we've had many examples. So that's a key composite profile from a key area where the market has topped out from a daily chart perspective right up to where we are right now. Okay, so let's see if we can find some more examples. Now, we had an area of acceptance right here, sideways market, 80 to 100% retracements, and we had a key area of rejection right up here. Now, this happened overnight, and we had to push lower. This area is the area I was looking to buy in the trading room, and that set up really nicely, and we continued to rally. Right, so if you can establish where key acceptance is by drawing your value areas, and some of you guys may have to attend or review the webinar that I did back in December 2010, because that covers how to establish custom value areas, as well as using the heat map profile, which you see on the right hand side. So this very much is a follow-on from that. So, in a balanced market, it's very much about establishing where the market is accepting. Where are the major market participants accepting right now? We saw it again in this range. And although we are looking at this after the fact, you have to develop the skill to do this in real time before it happens. So let's just move across. Now, one of the things we recognize, this market was becoming balanced. Again, characteristics of balanced markets. It's on the blog, but I discussed some of them today, but sideways market here, okay? So key LVMs, low volume areas above this value area. Where are they? Let's look at the red lines. Okay, right here. Okay, right here. Okay, right here. And you can see this market continue to rotate lower. There were some great trading opportunities coming back into this profile, this area of acceptance. Now, moving forward, we did see some acceptance here as well. So what we would normally do in the trading room is highlight an area of acceptance like this, and then highlight the low volume areas above it to trade back down, highlight the low volume areas below it. Now, this is a good example here where we actually continue to break down. But if you're looking for the best risk-reward opportunities, you will find most of them above and below value. Okay, that's what I have found, and you guys have to test that out for yourselves, of course. Now, that's pretty much balanced market opportunities. We're running out of time here, so what I would urge you guys to do is firstly understand what the characteristics of a balanced market is. It's a sideways market where there is a lot of volume accepted. We spend quite a bit of time. The market is generally making 80 to 100% retracements. And actually right now, I spoke about this earlier, this profile. And the most important thing to do, if you draw a profile like this, is to leave it building to present. Okay, this way it keeps it live. So you may draw that profile right to the present moment, but to keep it live, to keep it dynamic, you need to make sure that you understand where volume is developing. Now, one of the things that I highlighted about this profile is that it's not that symmetrical, meaning that we have splits in the distribution. Now, generally, in a balanced market, we would see more of a symmetrical profile. It will be a little bit more like this. So I'm either anticipating right now whether this market is going to fill out this area, and become balanced, or it's going to reject this balance area and then push away. Right now, what we can see, this market is live. It's just held a low volume area. A low volume area meaning a key area of rejection. Key area of rejection means the market is most likely to move away from it. What I would urge you guys to do is to look for entries at low volume nodes and low volume areas, not high volume areas. And sometimes that's the mistake that market profile and volume profile traders make. And I made that same mistake when I first started learning to trade. It may not necessarily be a mistake, but I learned that it generally doesn't work as often as a low volume area as a high or a high volume area. So, do keep an eye on this. So now let's move over to imbalanced markets. Imbalanced markets, to identify the opportunities, you have to try to envision firstly where the market is trying to go from and to. So from a longer time frame perspective, one of the things we spoke about today was more so initiative activity, but it was still below developing value, and that goes to our trading room members. But we also mentioned that we had some targets upside. One of those targets upside was 71s, then it was 72s, right? And that all came from the bigger picture, the daily charts. And the key thing when you're going with the market, or what we would call going with the trend, is to short bounces to developing and composite LVNs, or low volume nodes, or low volume areas on a profile, or aim to buy pullbacks to the developing or composite LVNs on a upwards trending market. Of course, confluence between the developing shorter term levels, which may be intraday and taking place within what we see right now within the last hour or two. They are better opportunities if they are in line with the confluence of longer time frame levels. So let's move back to the charts. Again, let's move back to the daily chart. That was a good example of how this has been happening. So if you look at the daily chart, it's pretty much been in an uptrend since the beginning of October. Specifically, since we held this low again in end of November and in December again. Let's draw a profile again. So let's get the profile drawing tool. Again, you can draw this in many ways. You can right-click on the chart, show the profile. You can draw it this way, so profile drawing tool. Let's just draw one this way. Okay, now this is a traditional volume profile. It shows the value area high, value area low. It shows the point of control. Now to change this, all you have to do is double-click on the edge of the profile where you see the dashed line. And one of the things you can do is, now there are a few more new options in Market Builder, and you can now display this as a solid gram, field, line, hollow line, streamer. Streamer is quite a good option because it shows you a line, as you can see here, and the more volume that trades at price, the thicker the line. The more lower the volume, the lower the thickness of the line. You can draw this as what I would class as a heat map profile. Again, I covered this in the webinars in 2010. Now, it doesn't matter how you display the profile, what colors you use. The concept is the same. Low volume areas, high volume areas. What are low volume areas and high volume areas? Even before we put automated tools on the chart here, where are the low volume areas in this uptrend? Now remember, this is fractal. It applies to every time frame. This is a daily chart. It applies to the 30-minute chart, 60-minute chart, a 10,000 volume chart, a Renko chart. Any time frame or periodicity you can think of, this is universal. So the concept of acceptance and rejection is applicable to any time frame. And remember what I discussed before, the theory. High volume areas are areas of acceptance. That's these areas. Low volume areas are these areas. We see low volume, low, high. Low, right in here again, high. Low volume areas are key areas of rejection. Low volume areas meaning that the market has proven that it doesn't want to trade there. So when it revisits those areas, the key thing to remember is low volume area, rejection area. The market participants do not want to trade there. High volume areas where there is a VPOC or high volume node, that's where the market is most likely to chop. That's where it is most likely to do this. If you get an entry at a high volume area, it may finally come off. But do be aware, if you enter and take trades and opportunities at high volume areas, you are most likely to be caught in chop. So you have to be very, very patient. Now with me, myself, when I like to trade, I like to get involved with opportunities that I feel may come off very quickly and may hit my targets very quickly. So let's have a look at the low volume areas on this daily chart. Uptrending market, of course, it's been since December. Where has this market found support? It's not really been that difficult to work out if you understand what you're looking for. Low volume area, right here. Low volume area, right here. Low volume area, right here. what's just happened recently? 1350, low volume area. Some of you guys know in the trading room, why was I focusing on buying the 1350, 51 area the other day? You can see it right here. It's a high probability level for a continuation of this trend. Right now, I am only focusing on the E-mini S&P, and this is a universal concept. You can put it on any market, any time frame. And we've got a few minutes, so I'll cover that quickly. But you can see that. Now, one of the things that Market Delta can do for you, and actually, it's probably a good idea if I just cover how I first started using volume profiling when I first started trading. Firstly, I didn't start using volume profiling in this way. Market Delta is a very evolved piece of software. In the last 2 or 3 years, it's made volume profiling very much more easier to use and easier to see and easier to apply in your trading. Volume profile, when I traditionally started using it in Market Profile, let's just move back to it. Just to give you some history. When I first started using volume profile with Market Profile in Market Delta, how did my charts look? Let's have a look at an ES Market Profile. Well, firstly, I used to use Market Profile like this without the profile indicator. Now, what I want you guys to see is that this is nothing new. This has been around a long time. I've been using volume profile for a long, long time and Market Profile. But only since I became a professional trader did I really see the value of, and by a professional trader I mean a prop trader trading alongside other professionals, but I see the value of volume profiling and Market Profile. I read books on it. It didn't make much sense to me. And one of the first ways that I started using Market Profile, volume profile, is the same way as most of you guys using the TPOs, the volume point of control, or the time-based point of control, value high, value low. But a long time ago, Market Delta made this available using a cumulative profile. And typically, we would specify the number of days that we want to look at. So in this case, I've got 30 days, and I would show a volume profile using all the data on the right-hand side. So I still use this because I'm visually able to see the setups and the opportunities on this very clearly, and it's a habit. But you don't really have to use this style of profile anymore. I still use it because it's a habit. That's how I started to use Market Profile and volume profiling. So some of you guys that have been covering my stuff and what I've been teaching over the last 4 or 5 years, or 5, 6 years actually, will understand that I started to use volume profile in this way, but low volume area, high volume areas in the same way. It's the same concept. So what I want you guys to see is it's the same concept, but on a different chart and applied in a different way. And I spoke about earlier on becoming creative with this level of understanding. And again, it's not that complicated. It's about understanding the context. What is the market trying to do? Is it balanced? Is it imbalanced? Okay, now that I understand this, where is the key areas of acceptance? Where is the key areas of rejection? That's all I want you guys to understand. Okay, don't necessarily have to take away the specific ways that I do this, because they will evolve over time, I'm sure. But the concept of low volume and high volume stands true, and it always will. One of the other ways that I've used Market Profile and volume profile is also actually on my trading platform. I've got a screenshot here. I want you guys to see this. It's actually of later on today. I use Trading Technologies X-Trader as my trading platform, through my prop firm. And one of the things you would have noticed here today is what? We've got a high volume area right here, low volume area right up here, low volume area right in here, 68.5. Now we broke through that 68.5, but still a volume profile. This is how I first started using volume profile. The reason I share that is because I want you guys to understand how, by understanding high volume areas, high volume nodes, low volume nodes, and low volume areas, and understanding what they mean specifically, will help you become creative by understanding just that basic knowledge. Apply that basic knowledge, high volume areas, low volume areas, and understanding the context of the market. Right, now these are some of the ways you can use it in trending markets. Now that's a daily chart. Now let's, one of the things we saw the other day was a trending market here. Actually, I didn't find a way to get into that, but let's have a look at some of the trending phases we've seen in this particular market, even the S&P recently. So, we've got value areas here. Basically, the way you want to use it is take the last prior low to the last prior high. Now, I've got some buttons here that just make this easier for me to do. So, let's just take this composite profile off the chart. Now, a trending market, it's not that difficult to figure out when you see a trending market. Higher highs, lower highs, right? Or lower lows and lower highs. So when you see that, how do you use volume profiling? Well, one of the things you can do, let's just say the market only got to this level, okay? We hadn't seen the rest of this move right up here, okay? We hadn't seen that. Okay, now let's just grab a composite profiling tool. Take that from this low up to the last high that was made. What you can see here, and again, pretending that the rest of it has not happened, what you can see here is where was the support found? Okay, now if you look to the right, you can see a composite profile. So it's very much like using a Fibonacci retracement. You take the last low to the high to figure out where the buys may be in an uptrend. You take the last high to a low in a downtrend to figure out where the sellers may be in a downtrend. Now in this case, there was an uptrend. Look at the red levels. Okay, these are low volume nodes. Okay, firstly we found some buyers here. Pop up. Now it doesn't have to be exact. Next level we found some buyers. Pop up. Now I'm just picking any area here. This is not predefined. Low volume area. Here, what happened? We found buyers. Okay, so you can do this in any uptrend, any downtrend. You look at the last low to high. Now let's have a look at the market right now. Okay, it looks like we're potentially trending lower again. Okay, let's just say we look at the market and we feel that it's trending lower. Let's grab a composite profile, take the high to the low. Where's the last low volume node? Look at this area right now. Okay, it's 8:05 p.m. GMT. Okay, this is a key area for sellers right now, as we see it right now. Okay, good chance we're going to test what? At least the next high volume node. Why? Because it's a key area of acceptance, 67 quarters. Where is it likely to go to next? 65.75. Right? Now, of course, this is not 100%. As with anything, it doesn't work 100% of the time, but a very good chance because the market participants, since the last high was made here, the last key rejection area is right here, that we may hold this resistance and push lower. Now, what's the next area of low volume? You can see it drops off here, but the market delta tool does not show you that level. Now, you can probably adjust the sensitivity levels to show you that. One of the ways you do that is just double click on the profile, maybe adjust that to one sensitivity, okay, and you can see there's an LVN right there, 71.75. So now you have a level not only to short at here, but also the next level to short at next. And again, I would urge you as market profile traders, volume profile traders that understand auction market theory principles, to not look for entries at high volume areas. Use them as targets. Okay, use the low volume areas. The great thing about market delta right now is that in the beta version, you can actually color code and choose the color that you wish to define for the peaks and valleys, which is the low volume areas, that's the valleys, the high volume areas, the peaks. So like I said earlier on, you could hide the peaks by putting them at the same color as your background, and you can display them by putting them at a lighter shading. So I am interested in them because I want to know where they are, but mostly I would use them as targets rather than entries. So hopefully you guys have got something from that. Balanced as well as imbalanced markets. Generally, with balanced markets, you want to look at composite profiling from a longer time frame perspective. Start on your daily chart. But right now, I started on the this profile here on the E-mini S&P. You probably want to take this all the way back to the highs of. This is what I currently have done. It's taken it all the way back to the highs of 2007, and then highlight your key areas by ticking this box. Now, I personally prefer to take the levels myself manually. That's just personal preference because I have always done it that way. But the software does help you out, especially if you're new to this. Shows you the high volume nodes and the low volume nodes. And then one of the reasons I like to do that is because personally, I don't like to automate stuff. I personally like to be in control. I like to keep myself engaged and focused, and if I have to find the levels myself rather than relying on software to do that, that keeps me focused. So although the market data software will do that for you, and it's a good way to start, I personally prefer to take the levels myself. Okay, so it will take the high volume and low volume nodes for you, but I personally prefer to take them myself. Right, now, so for balanced markets, just to reiterate, you want to take the levels from a longer time frame chart, your daily chart, and look at your 30-minute, 60-minute chart and see where they lie. Now, one of the things I did earlier on is took my 30-minute chart, started the date here at October 2007. So to get the levels for that, just to reiterate, I can draw a composite profile, start it from anywhere, double click on the profile, and then choose the option here to display that for all bars. That will then automatically show me for the periodicity that I have defined here, which is October the 11th, 2007. So that high, automatically I get all of the levels in reference to that if I put my chart back up to that time. And you may have to download the data. I haven't downloaded the data in this case for this particular chart. I don't think I have. So I may have to download the data, but that's the key thing to do. Now, probably the best thing to do for me is to show you some of my charts from today. These are my basic charts that I've been displaying today during the webinar. But if you give me a second while this loads up, you see my... There we are, that's the trades I took today. I got long here earlier on today, covered some, ended up giving back about a tick. Got long initially at 67 halves, covered some at 67 halves, and then at 67 at break even, and then at 66.75. Then I got long again in the trading room at 66 half, covered at 67 half, covered at 68 half, covered at 70 half. Then it took me out of my stop at 68, which is my trading stop. I got long again at 67s, covered at 68s, covered at 68.78, so it's 75, and then covered at 70 halves. So, and closing today's trading room session, I spoke about this setup here for the rotation back down to 66 and 66 half. Now, the way that I broke this down on the longer time frame chart, this is the chart that I use every day. This chart goes back to the date as I specified earlier, which is October the 11th, 2007. This profile on the right-hand side is a composite profile that shows me a heat map profile, show me all of the key acceptance rejection areas since that time. And it also, now I don't mark up the levels automatically here. what I do personally is highlight sell and buy levels before the market opens up as a part of my pre-market analysis. Now that's a whole other story. I do teach how to do that. There's some webinars on our website that are completely free that you might want to check out. Let's go back to that. You might want to check out our webinars right here. Go to seminar webinars, webinar archive. There's a lot of seminars here that I've been putting up here since, or probably over the last 3 years, that covers my methodology. Obviously covers a lot more in terms of trade execution, trade management. Today I'll be focusing a little bit more on understanding the market, understanding where to get in, and that's pretty much about it really today. But yeah, we do have an upcoming seminar if anybody's interested in the seminar. Do check that out. We've got a few products up there. Check it out, l2sc.co.uk. Do feel free to check it out. And watch our free webinars. There's loads of them on the website. And it covers lots of this stuff. Now, that's pretty much the end of my presentation. So what I'll do is, if you've got any more information, if you need any more information and you want to find out more about what I do and L2ST, do visit the website at l2st.co.uk. Feel free to email me at info@l2st.co.uk. And that's it pretty much from my end here. I'll take a few questions and I'll just wait for Trevor to throw them across. Thank you very much for joining me, and hope you guys found something of interest here. And like I said, if you can just take 1 or 2 things away from today and put them into practice, I've done my job. Thank you very much, guys.
Cam, if you open up the questions panel and just sort it by answer, and it looks like I have to just assign the questions to you. I can't copy and paste them. So see if that works. If you see the question, I've only assigned 1 at this time. Are you able to see them, Cam?
Trevor, I can actually see the question, so I'll take the last few, I suppose.
Yeah, I flagged some so you can see the ones that...
All right, yeah, I can see them, yeah. Okay, right, thanks, guys. I'll take the questions right now. Thank you very much, Trevor. Right, first question we got, does your profiles use volume or TPOs? No, they do use volume. So to answer your question, Bill T, my profiles and everything that I've been speaking about today does apply to the TPO profiling techniques. However, I specifically focus on volume profiling. Time is really important, as I spoke about before, but it's not nearly as important as volume. So it is volume profiling, and if you're not quite sure, if you go to one of the charts, like for example here, I hope you guys can still see this. There's actually an option to draw your profile using volume, or you can draw it using time. Now, if I change it to time, it won't make that much difference. But what I would urge everyone to do is use volume. Okay, I mean that's how I first started using profiling. Market profile, yes, it talks a little bit more about TPOs and the amount of time the market spends at price. That is important. Like I said earlier, now time is important. It gives you an idea of how long the market is spending at particular prices. It shows that people are interested. But volume actually shows you how interested they are. So use time to show you that people are interested. Market participants are interested. Okay, but use volume at price to see and determine how interested they actually are. So I would say volume, right, Bill, to answer your question. Right, got another question here, Radu. I know you trade the DAX and the Euro stocks. Well, actually, I trade the DAX and the Euro stocks and the Euro Bund during the European session. Like I said before, my trading method is very much adaptive. So last year we saw a huge increase in volatility in August 2011, and I would say from 2007 right up until August 2011, I was focusing mainly on the DAX, and that was my main market. As well as whatever I traded during the European session, so the US session. But, you know, I focus more on the Euro stocks since August. And now in January, the volatility reduced a little bit, and the ranges became very tight, not only on the Euro stock, but also on the E-mini S&P. Now I trade the E-mini S&P in the trading room. And you know, and I stopped trading that from around 2009, but I started trading again since October 2010, sorry, 2011, and that's been the case. And yeah, the volatility has reduced quite significantly, and I'm sure most of you guys are aware. So just reading for the rest of your question, risk reward for your points for both instruments. Now the risk reward is generally, you know, I'm looking for, on the DAX, I'm looking for the potential for at least 100 to a 200 tick move. Now, it doesn't mean I'm going to get it. On the Euro stocks, I'm looking for the potential for a 50 to 100 tick move. Now, again, it doesn't mean I'm going to get it. Most of my trades on the Euro stocks since August have been around 20 to 30 tick trades. You know, and if I hold my runners, I'll get probably 30-40% of the time around 60 ticks. Now, that's not available anymore. The most I will get out of the Euro stocks right now is about 20-30 ticks. So, you know, of course, you're going to have to understand that the volatility shifts and changes. I mean, how many points? Now, in reference to points, now I don't really count points, but I tell you how much I'm looking to make per contract per day. Now on the now I am focusing primarily on the Euro Bund during the European session, and I have been because the Euro stocks was a little bit slow in the beginning of this year. And I generally look for about 8 to 10 ticks first target, between 15 to 20 ticks second target, and the third target is between 20 to 30 ticks. Now the fourth target I would normally go for between 40 to 60 ticks. Sometimes more, but again, it depends on volatility. So a lot of this does depend. It's not sort of a, my method is very much adaptive. I adapt to the current market conditions and what is happening right now. And I show people how to do that in the trading room. So thank you very much for your question, Radu. What is a value area? ORS. Value area is basically where 70% of trade took place. Now you can adjust that. Now let's have a look at the value area where we are currently trading on the E-mini S&P. Okay, so we've got a value area, we just held the 65, we rallied it back up. Now, the value area here for the E-mini S&P is looking at 70%, okay? That's the typical way to look at value. Where has 70% of the volume traded? If you are looking at a volume-based value area, it's where 70% of the volume has traded. Now, I know a lot of traders have moved away from auction market theory concepts and move towards volume profiling, but forgetting some of the most important concepts of value. And I would urge everyone to understand what value is all about and understand that it applies to everything that you do as a trader and every market you trade in every time frame, and it provides a great story for trading around. So if you just trade levels, it's very difficult. Step one of my game plan, the old twisted game plan, is about understanding structure and value, and understanding where 70% of traders have traded is an important part of it. All right. How do you draw the value area? I mean, generally, this is a question from Bill. Sorry, this is from Oz again. Let's just show you again. You know, the characteristics of a balanced market. You have to understand that firstly. Characteristics of a balanced market: sideways. Okay, moving sideways. You can look at this. You don't have to look at exactly every swing high and low. You can see this market is sideways. It's not trending right now. So whenever you have a balanced market, I will just typically take a profile tool like this, grab the beginning of the profile, right beginning of the range and just drag the profile across right to where we are right now. And then I will click on the profile, double click on the edge of the profile, this dashed line here, and then I will leave that building to present, right? And you define that right here. So, you always have to understand where value is trading, where value has been found. Where are market participants right now? Because at the end of the day, you have to remember you are trading people. You're trading what people are thinking, believing, and that's what leads to their behaviors. What they believe leads to their behaviors and leads to what they do. So if you're trading people, you need to understand what they are thinking. So an area of value is really, really important, and you have to understand the key characteristics of a balanced market. Again, go to the blog. The key characteristics of a balanced market are explained there, as well as imbalanced markets. Can I show the 6C later? Absolutely. I actually covered the 6C in the trading room, and I have had to trade the 6C, the euro, during the trading room at times, and ahead of the trading room when I trade during the European session, because beginning of January was quite slow. I don't know if you guys recognize, but the euro is one of the markets that was actually quite moving quite well. Now, I haven't looked at the euro all day, but these are some of the levels that I took earlier on. One of the things I told you guys today, I spoke about this in the trading room earlier today, is that we have a key value area building here for the euro for quite some time. And I spoke about this towards the end of 2011. It was coming into some key unfit lows, and everyone was saying the euro is dead, it's had it, because we were seeing a sell-off. I said, look, we have value. Market participants are rejecting below this area. Let's see what happens when we get there. We got there, what happened? We rejected up again. Okay, so, again, applying some of the concepts that I've talked about today, and I've got a volume profile there on the side, right-hand side. Let's just put some of the levels on right now. Or let's just look at some of the levels. Okay, so some of the key levels here was, okay, low volume area right here. Okay, when this volume dried up, right there. It was right at that unfit low. Below that, where do we have low volume? Right here. Okay, below that area. Okay, so you can pick these areas out. These are the areas where we're expecting, if the market gets to, we might find key rejection. Now, we've already seen that, and this is a weekly chart, and we've already pushed up. Now, I typically expect this market to either roll over from this high volume area and test lower for more buyers, or continue to push up because we're in a triangle and push up towards that 1.4336 area. Okay, not to be exact, but you get my idea. So we got the bigger picture here as well. This is some of the things we've been looking at. We had key areas of value trading. We traded this value area for quite some time, and we've been covering this again in the trading room. And I've been watching the euro really closely with the euro debt crisis. We had a nice sell-off here again. That wasn't anything unexpected. Notice where we got into before we had this reversal. What is this? Low volume area. Low volume area. What happened? We saw rejection. What has the market done since? Rallied higher. Right? So, you look at the euro right now, we don't have a lot of key rejection areas right now. Maybe 1.3471, 97, 508, maybe for intraday trading, or from a longer time frame perspective, there's not much there. Okay, not until we get all the way into 1.3984. So, as far as I'm concerned, maybe 1.3592 right here. Okay, so as far as I'm concerned, we will be pushing up to test this 1.3498 area, then 585 if we can continue to push higher. Now, if any of these rejection areas hold, we'll of course see a reversal. Now, there's a lot more to happen, and this is looking longer term, and I don't focus too much longer term, but you get the idea. You can see how you might apply this. Right, so let's keep moving down to some other people. What do you do if we start trading in an area of little or no historic volume price? Actually, we've got a very good example with the NASDAQ right now. But the thing you've got to remember is when the market trades at new prices, it'll be developed volume. So this is, taking your question, JT. What I do is I don't use volume profiling itself. I use Fibonacci as well. And actually, one of the things you'll notice here is on my E-mini S&P charts is some yellow lines here, 1272, 1618 extension. So, we go back to using traditional mathematical models or, stuff like pivot points, Fibonacci. Now, I personally use Fibonacci. So if we're breaking above into new highs, I typically take Fibonacci extensions. That's what I do. And then I have a look to see if we are testing those areas and breaking through those areas. So, but, remember, again, this is the NASDAQ, and these are some of the levels that we had earlier on. We continue to break through some of these areas, and, we held the key support area where I got long today on the NASDAQ. I got long on the ES, but the NASDAQ held at the same time, and we got through some key resistance areas. And this is what I call pass-through rejection, what I spoke about earlier. But, at the same time, remember, when the market trades, volume will build. So, this market, NASDAQ, for example, has traded into new territory. It's never traded up here before. But, at the same time, we've got a low volume area up here, a low volume area down here. So they will establish themselves. So they may not be there when the market initially goes into price discovery. That's what we call it. But they will build. Okay? So I will wait for those times when we don't have the information that we need. And the reason it's called price discovery is because the market has to find information about those prices. And that means trading up there to see what is accepted and rejected. Right, let's keep moving down. I don't really cover the Australian dollar and US dollar. Radic. All right, thank you guys. See some of you guys from my room putting some nice kind comments up. Right, okay. Fran, good question there. Fran has asked a question, is it necessary to use tick data from 2007 or minute? Now, depending on your data feed, you actually won't be able to get tick data for that far. Okay, so it is minute data, but it's good enough. But it's based upon what minute data is based upon the closing tick data. So it's looking at how much volume traded at each minute bar. Okay, so you can use minute bar data, and actually I download minute-based data to get my levels. If you, I only really use 3 to 4 days of tick data. So you don't need tick data. You can download historical data for minutes, and you'll still get the volume profiles with the right levels. Right. Anyway, guys, thank you very much for joining in. We have to wrap up now. We've gone a little bit over. So thank you very much for joining in. Again, if you need more information, please feel free to drop me an email, info@altruesty.co.uk, or visit our website, www.altruesty.co.uk. This webinar has been recorded, and I'm sure Trevor will make it available to all of you guys. Thank you very much for joining in. Sorry, we're a bit short of time, so I could talk all day long, but thanks for joining in.